Hello, and welcome to the Fin Know-How lesson on balance sheets. In this lesson, we're going to expand on the prior discussion we had uh, broadly regarding financial statements. As you may remember, the balance sheet, along with income statement and the statement of cash flows, is one of the most important financial statements. Okay. So in this video, we're going to take a deeper dive into the balance sheet, the information that a balance sheet provides, what it contains, how it's organized, and how to make sense of it. As you may recall, in our intro video, we discussed the fact that financial statements are like different views of a house. Each view offers unique insights, in the case of financial statements, into the business's financial health. A balance sheet is one such view. And you may also recall that we described the balance sheet as a snapshot of what a business owns and owes on a specific date. So just to clarify, if you think about a business whose only asset is, say, an office building, the balance sheet at its simplest level will tell you what the building is worth, the size of the mortgage loan that the company used to finance the building, and it will also tell you the net worth of the business. That is the value of the building, its assets, less the loan outstanding. Um, so if you were to go back to our accounting terminology, the building would be what you call an asset. The loan would be what you call a liability, and the net worth, difference between the assets and the liabilities, is what you called owners or shareholders' equity. So that's a quick refresher, and then we're going to dive deeper into the details of a balance sheet. Okay. So we're going to start with the basic structure of the balance sheet. So what it has are two columns. On the left-hand side, we have the column which is a headline assets. And within this column, everything that the company owns and controls, such as cash, inventory, or machinery and equipment and other fixed assets, are all listed. On the right, we have the column titled Liabilities and Equity. This column provides details regarding how the assets on the left-hand side, the equipment, the inventory, are all financed. So it tells you where the money to fund the assets came from. It's going to come either through borrowing or ownership. If it is borrowing, then you would call it liabilities. If it's ownership, you would call equity. Right? So at the end of the day, the right-hand side is an explanation of how the left-hand side was financed or funded. And if that is the case, a fundamental equation has to hold, which is that the total assets must equal total liabilities and equity. In other words, how the assets are funded has to be fully explained. And that's why you have the truism that holds for balance sheets that assets equals liabilities plus shareholder equity. Okay, so we're going to start looking at the balance sheet in a little more detail. One specific aspect of a balance sheet that you always have to remember is that unlike an income statement where you're trying to measure sales, profitability, and activity of a business over time, the balance sheet provides a snapshot at a specific point in time. Okay. So as in the case of the company that we discussed at the beginning, if all they have are as an asset is the building, it will have on the asset side the worth of the building. On the right-hand side, it'll have the loan outstanding as of today. And it'll also tell you what the net worth of the business is today. So it's all a snapshot in time. And anything else that I want to add here? No. So let's go on to the next page, and start defining what assets are. Okay. So an asset under the accounting rules is a resource that the company controls, that the company controls in terms of its deployment. And it has the potential to provide future economic benefit. Okay. So the that definition of assets can include various types of assets. So it's worth taking a closer look at the various types of assets that show up on a balance sheet. The most common and the most familiar type of asset that shows up on a balance sheet are tangible assets. These have the quality that they are physical in nature. You can touch them. So if you have a building, if you have a vehicle where you have equipment or you have inventory, they are physical in nature, and so they can be counted, touched, so on, right? So those kinds of assets are called tangible assets. Then you have what are called intangible assets. These are assets that are of the mind, meaning that they are, you know, technology breakthroughs. They can represent trademarks, copyrights, brand values, and so on. So the defining feature of intangible assets is their non-physical resources, but it's still very, very helpful. In fact, the entire software industry, the tech industry, is these assets are mostly intangible in nature, much less tangible, whereas the old economy companies were much more heavily tangible than intangible. And one other type of assets that I wanted to bring to your attention is called contractual rights. So, for instance, if you have the right to collect royalties, or if you have the right to collect toll for a bridge, right? Those rights are valuable too. They are a contractual right, but they're valuable too because that gives you the opportunity to collect cash flow in the future, right? And from customers. So contractual rights are also an important piece of the asset puzzle, if you will. And so I just wanted you to be aware of that. It may show up in different ways and may not be as common as tangible and intangible assets, but nevertheless, it's an important asset type. So under the US GAAP and the International Financial Reporting System, the value of an asset is recognized when there is confidence that that asset will generate benefits for the company, and the value of those benefits can be measured reliably. Okay, so if there is no hope at all that let's say my biggest contribution to a company is an idea of a business, but nothing has been done with it, and there is no evidence that that idea can be executed on, it's still useful, but to declare it an asset requires you to have some confidence that the benefit from that idea is truly possible, and the benefit can be measured. But at the same time, it does not require certainty that that an asset has to generate profit. It's only the probability that that asset will generate future benefit should be high enough to make it categorized as an asset. Now, if you look at the asset side of the balance sheet, what you will find is that assets are listed in descending order of liquidity, meaning how quickly they can be converted into cash. So on top of the list in an asset, on the asset side of the balance sheet is typically cash or cash equivalents. Assets that can be quickly converted, instantly converted to cash, or cash itself, which is available in the bank. So that is already money, so it appears at the top of the list. Then there are certain other kinds of assets like receivables. These are payments due to the company in the short term, the payments that the company can expect to receive from its customers or certain other third parties in the near term, those tend to be considered more liquid because the turnaround time for collecting that money is typically short. Same with inventory. So if you have some inventory, it's quite likely that the inventory will be sold and converted to cash. So any kind of asset that can be converted to cash within 12 months are called current assets, and they tend to show up toward the top half of the asset column. The less liquid assets, the long-term assets, machinery, equipment, things that are not expected to be sold anytime in the immediate future, but rather they are used for production or for operation, those kinds of assets will tend to be at the bottom of the list. So the key takeaway from this page is that the assets are organized in the descending order of of liquidity. The most liquid assets are the top, the least liquid assets toward the bottom. But in addition to the order of liquidity, there's another aspect to this that you may want to pay attention to, which is that you can there's a lot that can be revealed about the nature of the business of a company by looking at the proportion of assets that are current versus fixed. So in a traditional old economy business, you would tend to have heavy machinery and equipment. So the fixed assets side of the balance sheet would tend to be big relative to the current assets, right? So after the total assets, fixed assets would be a larger proportion. Uh, Whereas in an asset light business such as software, you don't need a whole lot of fixed assets. So the fixed assets tend to be a smaller proportion of the balance sheet, or it may be the case that the total assets itself required to support a business of a certain size may be much less because of the asset light nature of the business in modern high tech businesses, such as you see with the Magnificent Seven type companies, such as Google or Alphabet or Meta or and so on. Right? So that's something to keep in mind. Now, going to focus now on this of the three of the different types of assets. We're going to focus first on current assets. So the current assets are particularly vital for day-to-day operations. So as we noted earlier, it includes things like cash, which is money in hand or in the bank and ready to use immediately. Then you may have other kinds of short-term assets such as inventory. Inventory may mean raw materials that are yet to be converted to the product, or it can mean finished goods, or it can mean um, the, those pieces of inventory that are in process of being converted to a product. And so those are um, a critical piece, especially in a manufacturing kind of setting. So inventory tends to be an important piece of the current assets in where physical products are involved. And you will realize immediately that the inventory itself is purchased using cash, right? And so there is a cycle that starts to happen where cash is used to convert to inventory. Inventory becomes finished goods. The finished goods get sold, and then out of that comes profits, which then replenishes the cash. That process, by the way, is called the cash cycle. So the if too much cash is tied up in inventory and inventory is not being sold, that can be detrimental to the operations of the business. So how the cash is managed and through the cash life cycle is a important consideration when you look at companies to see how efficiently they are managed. And this becomes super important when the company is tight for cash. If the company has not been profitable for a bit and cash is hard to come by, the managing the cash cycle suddenly becomes way, way more important than it was that would be in a very profitable, successfully operating company. Then we come to the next term, which is accounts receivable. Accounts receivable has to do with the fact that when you sell a product or a service, the customer typically does not pay instantly. They tend to pay, especially in business to business transactions, they're given 30, 60, and 90 days to make the payment. Right? So the customer owes the provider of the product or the seller of the product a certain amount of money. They do have the product in hand, they're able to use it, but they have 30, 60, or 90 days to make the payment for having gotten access to the product or the service. From the seller standpoint, this becomes essentially a loan that they're extending to the customers for a short period of time, of course, 30, 60, or 90 days typically. So what it represents to the seller is a loan or the right to collect payment within 30, 60, or 90 days in return for having provided the product or the service. And then finally, the last piece of the current assets list is prepaid expenses. These represent expenses that have been paid because, for instance, if you are buying insurance, you don't pay for insurance after the fact. You have to pay for insurance ahead of time. You typically pay for the insurance at the beginning of the month. Some landlords might require you to pay for rent at the beginning of the month, or you might be paying for subscriptions, which you will use over the course of the year and so on, right? So these are expenses that are where the cash has gone out of the company, the value will be realized over time. Okay. So these are typically the most common types of current assets you see. And yes, there could be other kinds of current assets too in particular companies, but broadly speaking, this would be the four that are most commonly observed. One other thing that I would mention is that, coming back to this idea of the cash cycle. So remember that it is not a once and done transaction where cash is converted to inventory. It's a cycle that gets started when cash is converted to inventory. The inventory is then sold and profits are generated, and then that replenishes the cash. So what you have is a continuous cash cycle that's ongoing. Why this is important is because the company has to efficiently manage the cycle, so it always has the right amount of cash to meet its short-term obligations. If too much cash is tied up in raw materials or inventory, then the company may not have cash at hand to meet its short-term obligations, such as covering payroll. And so the managing the cash cycle is a very important goal, and the more flush the company is with cash, it probably recedes a little more into the background in terms of all the goals that the company wishes to achieve. But if the company is tight for cash, of course, this comes to the forefront very quickly. All right. So far we talked about current or short-term assets. Now we're going to switch gears and move to what are called long-term assets. Long-term assets are also known as fixed assets. And unlike current assets, and like we noted earlier, fixed assets are not meant for sale. They're used to run the business, and they include assets like machinery, technology, or buildings. So we will first examine a particular type of long-term assets called tangible assets. We referred to that earlier. They tend to be physical in nature, buildings, machinery, equipment, and so on. So what happens is that when a tangible asset is acquired, its value is recorded on the balance sheet at cost. Okay, so what you see on the screen, you have a machine that cost $100,000. Value is recorded on the balance sheet as $100,000. Now, over time, like in the case of a car you buy, these assets lose value. And now to account for that loss of value, accountants use a technique called depreciation, where they try to estimate the loss of value. So in this case, let's assume that this machine costs $100,000, bought it for 100,000, recorded it at $100,000. At the end of the year, first year, let's assume that the accountants estimated the loss of value from the decline in value of the asset to be 20,000. Here, what they're essentially doing is that the accountant is assuming that over 5 years, it loses $20,000 in value every year. So by the end of the first year, after 1 year has passed, the value on the balance sheet has to be corrected from $100,000 to $100,000 less $20,000 or $80,000. The $100,000 is still recorded as the gross value, but the value at the end of year one is called the net value, and the net value is the original value at cost less or a net of the depreciation that has been built up over this year. By the time it gets to the next year, you have lost 2 years worth of value. So you have accumulated depreciation of 40,000. So the net value now drops to 60,000. Now, just to be clear, this doesn't mean that if you were to sell this machine at the end of 1 year in the market, that it will sell for exactly $80,000. It could sell for more than $80,000. It could sell for less than $80,000. All it means is it is an estimate by an accountant to try and address the loss of value. So just to make this clear, so often what's recorded on the balance sheet for this asset, whether it's the gross value of 100,000 or the net value of 80 or 60,000, are often referred to as book values to distinguish it from what would be market values. So the key thing to remember here is that accountants do try to attempt to reflect the loss of value over time of an asset, but the way they do it is through estimates which may or may not match the true depreciation, or in other words, the net book value recorded in the balance sheet may or may not match the market values perfectly. It still is valuable to recognize that there is a loss of value. The question is whether the loss of value is accurately picked up or not. Oftentimes, these kinds of adjustments made by accountants are reasonable proxies. Never perfect, but it's not a bad way to try and reflect the loss of value. It's an approximation, but good enough approximation in many cases. So next, first we talked about tangible assets. So we are going to now talk about intangible assets. What's different about intangible assets, of course, as you remember, is that it's non-physical nature. From a balance sheet perspective, the rules that apply to the recording of the value of intangible assets is somewhat less intuitive. The way it works is that if the intangible assets, whether it's patents or brand names, are acquired from a third party out of a third party transaction, those assets, intangible assets, are called acquired intangible assets. And those acquired intangible assets are recorded on the balance sheet, like in the case of the machinery we purchased in the last slide, recorded on the balance sheet at its purchase price. So that it is gross book value. And analogous to depreciation for tangible assets, there is a technique that accountants use for intangible assets, and that's called amortization. So amortization is a way to account for the fact that this is intangible assets to decline in value over time. For instance, due to technology obsolescence, for instance. And that is how acquired intangibles are treated. So they treat the gross value, book value is the price at which it was purchased in a third party transaction. The net book value then each year declines as these acquired intangibles are reduced in value through a estimated number called amortization that accountants use. The same set, let's now assume that the same set of assets were not purchased from a third party, but were developed internally through R&D, for instance, or through marketing efforts. So, so where the accounting of intangible assets gets quirky is that if these assets were internally developed, they will not show up on the balance sheet. Okay? Same assets, but because they were internally developed and not acquired from a third party, they are not recorded on the balance sheet. The logic for that is tied to the principles of being conservative in its recording. So, unlike in the case of acquired intangibles, where a value was established among third parties for the asset, when a intangible asset is developed in-house, there isn't 100% confidence that somebody else will buy that asset or it's interested in that asset. So without knowing that, accountants are hesitant to put a value of that asset on the balance sheet. So they just treat it as an expense in their income statement and nothing is recorded on the balance sheet. Okay, so this is an important distinction to consider. If you see a balance sheet which shows no intangibles recorded, that doesn't mean that the company does not have intangibles. All it means is that those intangibles are likely developed internally, and so there is not a mechanism to pick that up on the balance sheet. Okay. Those are the two main types of intangible assets: acquired intangibles and internally developed intangibles from a financial statement standpoint. There is a third one that that I want to draw your attention to. That's called goodwill. It's hard to explain what a goodwill is from a conceptual standpoint because it's an accounting driven asset. And the way it comes about is in the context of acquisitions. When a company is acquired, say for $100 million, and the analysis of the company's assets, after much research, you conclude that all you can identify specifically as assets for the firm and you can quantify its value is only $80 million. So there is $20 million that is unexplained. So you bought the asset, the company for $100 million. Your research indicates that you can tie about $80 million of value to specific assets and so on. But the 20 million gap is still unexplained. That 20 million gap in the accounting world is called goodwill. It's the unexplained portion, if you will, of the acquisition price. One detail that you should note here is that unlike acquired intangibles, even though goodwill came as part of an acquisition, it is not amortized. What happens is that accountants will regularly check if the goodwill amount recorded on uh, the books of the company are still are accurate. So for instance, if a business does not perform, if an acquired business does not perform as well as expected, the value of the goodwill may have to be written down. And if it has to be written down, it's said to be impaired. And accountants are required, unlike amortization, accountants are required to test the goodwill recorded on the balance sheet for reliability and accuracy on an annual basis. And these tests are called goodwill impairment tests. All right, so far we have discussed the left-hand side of the balance sheet, the asset side. Now we will turn our attention to the right-hand side or the liabilities and equity side of the balance sheet. And here we'll start with liabilities. So as you may remember, liabilities represent what a company owes to suppliers, to banks, or to the government. And again, as you may remember, they're listed on the right-hand side of the balance sheet above equity. Now, within liabilities, current liabilities, which are liabilities that are due within 12 months, are listed towards the top of the page. And while non-current liabilities, meaning liabilities that are due only after a year, tend to be listed towards the lower half of the column. In other words, like in the case of assets, liabilities too are listed in a particular order. And in the case of liabilities, they're listed in the increasing order of maturity, meaning that the liabilities that are due to be repaid sooner show up toward the top of the list, and liabilities that are due later show up toward the bottom of the list. By structuring the liabilities this way, it makes it easier for analysts to assess financial commitments and payment schedules and so on. Okay. So again, on the right-hand side are liabilities plus equity. Within that listing of liabilities and equity, we recognize that the liabilities tend to show up toward the top uh, half of the column. Uh, they tend to have a specific date by which they are owed. And within liabilities, those assets that are owed within under 12 months are listed as current liabilities and show up on toward the top of the column. And those liabilities that need to be paid only after a year tend to show up the lower part of the column. Okay, so now we're going to take a closer look at what we mean by current liabilities. So you can think of current liabilities as the flip side of current assets. So just as you extended credit to customers as accounts receivable, where you gave customers time to pay, say 30, 60, or 90 days to pay for the product or the service you sold them, remember that the company of interest is also a customer of other companies, meaning that vendors, may extend you credit for 30, 60, or 90 days. So this is the flip side of the case. So it's an IOU that you have that that has been extended to you by vendors. Now, just as accounts receivable was an asset for you and an IOU for your customer, now the equation is reversed. You owe the vendor a payment, and it's a liability for you, and that payment is recorded as an accounts payable. Okay. So we can think of it as the flip side of accounts receivable. Then you have short-term loans. Short-term loans, maybe let's say the company funded its travel using credit cards, and the credit card payments are due at the end of a period. Or you have a line of credit that you use; those are all due within short periods of time. So it would be an example of a short-term loan. Um, Often in current liabilities are also, again, within the short-term loans are payments that are due with respect to long-term loans. So it's not about the returning of the amounts owed in the long-term loan, but let's say you have an interest payment on a long-term loan that is due at the end of the month, that too will show up as a short-term liability, right? And so it will fall under current liabilities. Though technically it's part of the long-term loan, but because some portion of it is due in the next 12 months, it is recorded within current liabilities. That portion which is due within the next 12 months are recorded in current liabilities under short-term loans. Um, so just like you had prepaid expenses, the flip side of that is accrued expenses. So if you have employees who are working for you, but their wages are due only at the 15th of the month or the end of the month, you have received the benefit, but you haven't paid for them yet. So these are expenses that are building up, are accruing in the background, and these are liabilities you have, and these liabilities tend to be short-term in nature, so they're called current liabilities, and within that, they're called accrued expenses. Similarly, any taxes that are owed, whether it's sales tax or property taxes or other kinds of taxes that are due within the next 12 months, are also recorded as current liabilities within the line item taxes payable. Okay. Now, because short-term liabilities are due in the near term, managing these obligations is crucial to avoiding cash flows issues at the companies. In an ideal world, because current assets are also likely to be converted to cash within a 12-month time frame. It will be great if all the current liabilities could be paid off using current assets. So firms tend to track how much current assets they have relative to current liabilities. And that relationship between current liabilities and current assets is a aspect of short-term financial management, and that particular the difference between current assets and current liabilities. So if you take current assets less current liabilities, there is a term that is used to help you track that relationship, and that term is called working capital. So working capital is nothing but current assets minus current liabilities. It tells you whether you have enough current assets to cover your current liabilities. So this is a term that will come up again, but just wanted to flag it for you in the context of our discussion on current liabilities. Okay. Yeah. So that brings us to the last item on the right-hand column of the balance sheet, the liabilities and shareholders' equity. We talked about liabilities. We also talked about equity or the shareholders' stake. Previously, we described it as the worth of the business, the worth of the assets net of liabilities. And so it represents what's called the owner's claim on the business. So if you have $100,000 in assets and $80,000 in liabilities, what's remaining belongs to the owner of the firm, right, or the business. And so that's what's referred to as shareholders' equity. And because the owner gets what's left over after everybody else is paid off, these shareholders the shareholders' equity is often referred to as a residual claim, and the shareholders themselves are referred to as residual claimants, meaning that they get the residue after everybody else is paid off. Okay? So, and another way to think about it is that if you think about the balance sheet equation, total assets equals total liabilities plus equity, and if that were true, you can rewrite the shareholders' equity as assets less liabilities, which is exactly the way we characterized net worth. Okay? Now, what's different about equity compared to liabilities is that it does not have a due date. So liabilities such as a loan from a bank has to be repaid by a certain date. In the case of equity, there is no due date. It doesn't have to be repaid like a liability. And so that makes it a valuable source of financing when you're investing in long-term assets where the payoff from the assets may take a period of time and there is uncertainty about when that payoff will be realized. So if it were a liability and the liability were due in 3 years, but the cash flow, it's not clear that the cash flows will be realized in 3 years, then you have a problem. Now, if it is financed with equity, then you no longer have the problem because equity can be thought of as patient capital because there is no due date. Now, within shareholders' equity, there are two components that we need to pay attention to. One is called paid-in capital. So paid-in capital is money that is contributed from outside the firm into the firm by shareholders. Okay. So if you were starting the company, the money that you contributed, or if you sold a piece of your company to somebody else and they paid for it, that contribution to the company is all paid in capital. Right? If you had investors coming and they contributed more capital, if you had a fundraising event and investors contributed capital to the company, that would be called paid in capital. But there's another form of shareholders' capital, and that happens when some portion of the profits of the company generated by the business is retained to reinvest in the business. So this is not outside capital, this is internally generated capital that comes from profits of the business, and that portion of the profits that is retained by the company for reinvestment. You see a line at the bottom, it says that retained earnings may be negative if losses accumulate over time. And so that doesn't mean that the equity is negative. It just means that the retained earnings, if company has losses, there's nothing to pay out. All of the losses will show up under equity capital. And so if you reach a point where these losses are big enough, you may need additional equity capital to continue to operate the business. Otherwise, the company may become insolvent. Okay. Then now we're getting towards the last couple of points in this video. And what I wanted to draw your attention to here is this idea of linking assets and liabilities. We talked a little bit about working capital, where we tried to match the current assets to current liabilities to make sure that there was enough assets that could be converted to cash relatively quickly to cover the liabilities that are due within 12 months or so. So there is a aspirational goal that companies have to try and match the duration of assets with the duration of liabilities, meaning that if you have a liability that is due within 8 months, you want to make sure that there are enough current assets that can be converted to cash to cover that payment. And by the same logic, long-term assets should be financed with long-term debt or equity, because long-term assets generate cash flow over time. And so you need the time horizon on your financing side to be able to match the cash flow with the due dates of the liability. We also talked about the fact that if your assets are really long lived, and it's going to take a while before you're going to have the cash flows, equity might be super helpful in matching the horizons of the asset and the liability. So the word duration here, all it means is the time horizon, right? So by focusing on this matching principle, or having this matching of liabilities and of duration of assets and liabilities, uh, the let me take that back. So the matching principle that companies follow to try and match the maturity of assets and liabilities is helpful to manage keep the operations of the company stable. Now, the reality though is that while the companies may aspire to that, the the real world circumstances sometimes may not always allow it. So, for instance, the company at a given point in time may not have sufficient current assets to cover its liabilities, or the long-term assets may be temporarily financed with short-term financing till, let's say there is a financing round that's happening a month from now, but the assets are needed today. So you might finance the assets with short-term capital because you know that in a month, uh, you will be able to repay the short-term loan and then cover the long-term assets with long-term financing. So essentially, you're bridging at certain points the gap in maturity, but that's how the real world works. But still, the aspirational goal of the company is to try and match maturities. Okay. The final topic, I think, not quite final, we're almost there. So we will quickly bring back the concept of working capital. Working capital, as you may recall, is the difference between current assets and current liabilities. When current assets exceed current liabilities, you have positive working capital. So what you're trying to do is to have enough current assets to cover your liabilities so that you do not get into a liquidity issue. If you see a negative working capital, that means your current liabilities are exceeding current assets. So you may have to think about how you're going to cover them. So you can have situations where the company may be profitable in its operations, but because of this mismatch, they may struggle to meet day-to-day obligations. So that is a liquidity issue more than a um, a business operational issue. Um, so anything else that I wanted? So, and because it's no, and so if on the other hand, let's say you have your current assets are very high relative to current liabilities. what that means is that this is the flip side of what I described a second ago, right? Now the situation is that you got too much current assets relative to too much to current liabilities, and what that means is that the current assets are not being financed with current liabilities. There is a matching of duration issue because if current assets exceed current liabilities, it's coming from the funding of those excess current assets is coming from elsewhere, which tends to be long-term assets. So that creates a mismatch issue. So the reality is that this is a fine balancing act. The management of working capital is a tough balancing act, but companies, especially companies that are tight on cash, but even other companies tend to track working capital closely to make sure they don't have too much of it or too little of it, and they can manage their liquidity efficiently and effectively. Okay, so now this brings us back to where we started. So we'll close out the discussion by coming back full circle to a balance sheet. The only difference is that the balance sheet you see on the page is a little more detailed than the high-level view we saw at the beginning of the discussion. So again, reminder, on the left-hand side is assets, right-hand side is liabilities and equity. Within the asset side, you have current assets, assets that are due within the next 12 months. On the top, long-term assets towards the bottom. If you add up the typical types of current assets, cash, accounts receivable, inventory, and prepaid expenses, you get a total which is referred to as current assets. So as you can see here, if we label current assets as E, E is equal to A plus B plus C plus D. Okay? On the long-term asset side, you have net tangible assets. These are the physical assets. And notice I use the word net here, so which means it's the gross value net of the accumulated depreciation. Similarly, if there are intangible assets, acquired intangibles, as you may remember, the intangibles developed internally are not going to show up here. The acquired intangibles are also reported on a net basis here, as I'm showing it on a net basis. You could technically present both the gross value and the accumulated depreciation to show how you got to the net value. But for simplicity's sake, I'm showing you the net intangible assets. And unlike in the case of tangible assets, what's being netted out is the amortization, which is analogous to depreciation in concept. Other long-term assets may include things like goodwill. So if you add up all these long-term assets, which is F plus G plus H, you get net long-term assets. And if I add E, which is current assets, to the net long-term assets I get total assets. Now you have to remember that these total assets have to equal total liabilities. So we're now going to work backwards and see how these total assets are financed on the right-hand side. Here you have towards the top of the column all those assets which are due within 12 months. Accounts payable, accrued expenses, current portion of debt, and income taxes payable. And this current portion of debt may be short-term debt as well as that part of the long-term debt that is due within 12 months. If you add up K, L, M, and N, meaning accounts payable, accrued expenses, debt, and income tax payable, you get current liabilities. Below it comes the liabilities that are due in the longer term. So you have long-term debt. Then you have, on the equity side, you have paid-in capital and retained earnings. So the Q and R add up to shareholders' equity. So if I were to add O, which is the current liabilities, long-term debt, and shareholders' equity, which is the sum of Q and R, I get OP, the sum of O, P, and S, which is T. Again, the key thing to remember here is J has to equal T because the right-hand side represents how the left-hand side has been financed. So what are some of the key takeaways? Remember that the balance sheet equation requires the left-hand side and the right-hand side of the balance sheet to equal. The liquidity is an important consideration on the balance sheet. So the discussions around working capital and the way in which assets and liabilities are ranked and the time horizons that we have to factor in terms of how those commitments are paid off, are all important considerations. And one of the last principles we discussed in this video today was the matching principles, where we are trying to make sure that long-term assets are financed with long-term capital or funding, such as long-term liabilities and equity, and short-term assets, such as current assets, are funded with current liabilities to the extent feasible. So hopefully this gives you a much clearer view of what balance sheets are, what you can expect to find when you look at a balance sheet and what they convey. As always, do reach out if you have any questions. Thanks for your time and look forward to seeing you on our next video. Thank you.